6 undervalued dividend stocks near their 52-week lows. As always, we'll look at their historical performance, we'll take a look at their dividend safety, we'll look at some of their financial metrics, and we'll run them through the valuation model, getting to our intrinsic value as well as our acceptable buy price, given that investor margin of safety, and we'll look to see what Wall Street are forecasting for the next 12 months. So let's jump in with stock number 1, and we have the famous Starbucks Corporation. Now, as we can see, just yesterday it was down 2%, over the last year down 8%, and if you've been holding this over the last 10 years, you would be up 155%. Bear in mind, this doesn't include those dividends reinvested, and we see their all-time highs summer 2021 at around $126. Now it's trading not too far off its 52-week lows with a yield of 2.45% and a forward PE just under 23. Dividend safety score, we have a score here of 67. It does look to be safe. Market cap 105 billion. It is a mega cap company. Now, in terms of those recessionary metrics, if you see a recession inbound in 2024, well, there's no comparative data as they didn't pay a recession during that period. In terms of sales, they had negative 6%. Bear in mind, the S&P had around negative 12, so it is above the average growth for that time. But they did trail the S&P, negative 69% versus the S&P's negative 55. In terms of dividend growth, well, a nice increase in September last year, 7.5%. Double digits over the last 5 years, and some strong double-digit increases over the last 10 years, making this a very strong dividend growth company. In terms of the dividend increases, well, they have had 13 years of consecutive increases. In terms of dividend yield theory, now those that are new to the channel, it states the company is undervalued when the current yield sits above the 5-year average, 2.45 versus 2.01, so we have our first sign here. We also have another sign, so a double sign of undervaluation with the forward PE at 22, below the 5-year average of 29. But do bear in mind, we don't look at any of these in isolation, and we will conclude towards the end. We can, however, see the consumer discretionary sector PE sitting slightly lower at 15.2. Now, in terms of looking at the payout ratio, as always on the channel, we do focus on the free cash flow. Other investors who want to look at the earnings data is available to see on the screen, but it is susceptible to manipulation by management through accounting. And what we like to see, personally, below 60%, if you want to be industry specific for restaurants, below 50%. These metrics give us confidence that management, where possible, can offer those double-digit increases that we love to see. Now, what we're looking here in 2023, 67%. A little bit of a worry in 2022 at that 90% level, but nice to know it has come down in the more recent year. And in 2024, expectations around 63% believes us that we can see around a high single to a low double-digit increase to their dividend this September. Free cash flow per share, we want to see growth over the longer term. Negative 37 cents in 2014, 3.20 in 2023. So it has increased, very inconsistent, but again, if you are holding for the longer term, it does look fairly positive. 3.59 in 2024 expected. So again, we can see they are anticipating growth to that free cash flow per share from the previous year. In terms of sales growth, well, typically we want to see steady, moderate growth, 3 to 7%. With Starbucks, over the longer term, we're pretty much seeing double-digit increases to their top line. Notably, 2023, 12% looking very strong. And we can see that 2020 year, that justifiable pandemic COVID year, where they had negative 11%. So numerically, they've more than doubled their top line over the longer term, 16 billion in 2014, 36 in 2023. Now, they've also returned excess cash to investor pockets, as we can see here, through share buybacks, increasing the pie of which you hold the company. 1.53 billion in 2014, 1.15 in the latest quarter. So lots of positives here, alongside that increasing dividend on the strong metrics analysis. ROIC, now we want to see 10% or more to give us faith that management are able to effectively allocate their capital. And what we can see here, very, very strong. 33% in 2023, and in fact consistently over the last 10 years it has returned a very strong number for this metric, so lots of positives to take away. In terms of the margins, now what we want to see around that 16% level for the restaurant industry, it has straddled that nearly every single year, 15% in the latest year. It isn't a massive cause for concern, but something just to keep an eye on quarter, year to ensure it doesn't come down much lower than that. Free cash flow margin last 3 years looking fairly positive, 10% in 2023. Remember, we want to see a minimum of 5% for the restaurant industry. Moving on to a very important metric, the net debt to EBITDA, earnings before interest, tax, depreciation, amortization. This correlates directly to the dividend safety, as well as essentially the balance sheet strength. Now, these are the number of years it would take the company to pay off all of their debt net of cash on hand. For the restaurant industry, we want to see below 3.5. Nice to note it is below that, 2.06 in 2023, 1.89 in 2024 expected, so it is decreasing. This is a very strong sign for the company. Balance sheet looks good at an overview aspect, and dividend does look to be safe for now. So let's jump into the valuation of Starbucks Corporation. And as always, if you enjoy the content, values being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Now, typically on the channel, we do run through every single one of these models to get to the intrinsic value. For today's episode, let's jump straight into the final calculation. And what we can see for today's episode, we get an intrinsic value of around $115. Now, the current price has suffered. It is down around $93 currently. And what we like to do is start off with a margin of safety of 10%. And we use that if we believe it meets 3 criteria: a wide moat, strong financial metrics, and good forward-looking data. So an acceptable buy up to 104 if you believe that is sufficient. And then we keep going till it's near the current trading price. And we can see it is around a 20% margin of safety at around that $92 mark, which is only around $1 shy of the current trading price. So for Starbucks, we see a 20% margin of safety level. What do Wall Street say? Well, they believe there to be a price target of $112 over the next 12 months. They see strong double-digit upside of 20%, making them see this as a strong buy for the next few years. As always, though, do let us know your thoughts on these stocks as we go through them. The next undervalued dividend stock we have is Nike Corporation. Now, this is one that has been hammered down 14% over the last year. But if you've been holding over the last 10 years, similar to Starbucks, you would be up around 156%, excluding those dividends. And we see the all-time highs around that 170, 180 level in November 2021. Now, the yield is currently around 1.45%, a forward P of around 28.29. And when we take a look at that dividend safety, we have the highest score obtainable, 99, very safe. Market cap, 154 billion. It is a mega cap company. Now, in terms of those recessionary metrics, while they increased the dividend during the last recession, they had above average growth and they also outperformed the S&P with their negative 36% return. Dividend growth pretty strong as well, just under 9% last November, double digits over the last 5 years, double digits over the last 20 years as well. When we do take a look at this, we can see they have been increasing those dividends for the last 21 years, making them 4 years away from becoming a dividend aristocrat, and they have paid a dividend for 39 years without a reduction. Now, dividend yield theory, we have that strong sign of double undervaluation, the yield higher than the 5-year average, and the PE lower than the 5-year as well. So looking good for an undervaluation signal, but we do note the consumer discretionary sector PE is sitting much lower at 15.2. In terms of the free cash flow payout, now again, this is why we do say we look at the free cash flow. In 2020, they paid out more in dividends than they generated in free cash flow. If you were to look at the earnings, you would be none the wiser. Now, what's nice to see, since that point, it has been fairly low, 42% in the more recent year, 26% expected in 2024. So we can see that we should have some realistic expectations of a strong double-digit dividend increase, or at the bare minimum, a strong high single digit. $1.21 on the free cash flow in 2014, $3.14 in 2023. So some strong growth. It is consistent, or as consistent as it could be. 2024, $5.73. So what we can see here is over the longer term, it is moving in the right direction. But there are some years where it does fall, notably like we saw in 2019 to 2020. But then it did rebound pretty strongly. In terms of the sales growth, well, what we want to see, remember, steady moderate growth, 3 to 7%. 2023 at 10%, nice to note that double-digit increase to their top line. 2021 the same. Even in 2022, it was between that 3 to 7% level that we like to see. Numerically speaking then, it's gone from 28 billion in 2014 to 51 in 2023. What's nice to note as well, another company that does some nice share buybacks, reducing their share count from 1.81 billion to 1.55 in the latest quarter. In terms of the ROIC, it does look like it has started to decrease from the highs of 29% in 2014, but even at that 21% level in 2023, it is still a very strong metric, and what we personally want to see is a minimum of 10% for companies that we'd like to invest in. In terms of the margins then, we do see a very consistent around that 12% level for the large part of the last 10 years, and we see a 12% in 2023. The only thing I would say here is just to keep an eye on, given the fact that it is straddling around that for the large part of the last 10 years, you want to ensure they can at least maintain that at a bare minimum. Free cash flow margin, fairly strong as well. The last 3 years looking very nice. 10% in 2023 is also a nice positive. Net debt to EBITDA, well, this is fantastic. 0.19 in 2023. 0.27 expected in 2024, well below that 3 that we want to see. So we can now see, in conjunction with their low free cash flow payout and that essential net debt to EBITDA metric, which is very low here, that dividend does look to be safe, and we can understand why it has a 99 score. So let's move on to the valuation now of this company. Is it one that we should be considering to add to our portfolio? So let's take a look at the valuation. As we can see here, it is made up of these two models, coming to an intrinsic value of $122. Now with the current price at 102, again we start off with that 10%. It is a buy up to 109. At 15%, it is pretty much around the current trading price. So up to $103, we see a 15% margin of safety for this company. In terms of Wall Street and their forecast, well, again, they see this as strong upside, 21% over the next 12 months. They have a price target slightly higher than our intrinsic value of $123. So similar to Starbucks, Wall Street do believe that Nike is a strong buy now. Moving on to the next company then, we have Lockheed Martin Corporation, down around 10% over the last year. However, over the last 10 years, a pretty similar record to Starbucks and Nike. They are up 156%, although we do see them touch just under $500 in 2022. And over the last 52 weeks, it has hit around $508. Now, the forward yield is just under 3%, 2.95 to be specific, and a forward P of 16.4. Dividend safety score 84, it is very safe. Market cap 103 billion, a mega cap company. In terms of the key metrics, while they increased the dividend during the last recession, they had above average growth, and they also outperformed the S&P, although marginally at that negative 46% return. Dividend growth 5% in October 23. Remember what we say on the channel and advocate is a minimum of 4% just to keep up in line with inflation. 8% over the last 5 years looking positive, and a strong 16% average over the last 20. They have also been increasing those dividends for the last 21 years and paying a dividend for the last 31 without a reduction. Now, dividend yield theory, again, we have an undervaluation signal on the yield, 2.95. It is above that 5-year average, but we do see the forward P sitting slightly higher, 16.4 versus the 5-year average of 15.8. But we do note that Lockheed does have a lower P than the industrial sector at 19.7. So what about the payout ratio? Other than 2018, which again it went over 100%, and we can see the earnings, it doesn't show that. We can see that they are a very, very strong company. Their free cash flow payout is pretty much below 50% for the large part of the last 10 years, 49 over the last 2 years, 51 expected in 2024. In terms of the free cash flow payout, well, what do we see? $9.54 in 2014, $25 in 2023. So nice strong growth over the last 10 years. But do note in 2024, it is expected to be fairly flat in relation to the free cash flow. Sales growth, a little bit inconsistent, but over the longer term, it is just about scraping that 3 to 7% if you wanted to take the average. In the more recent year at 2%, a little bit disappointing, especially given 2022 was a year where it had negative growth on the top line. Nonetheless, over the longer term, it has increased from 40 billion to around 68 in 2023. Again, similar to the previous companies, they do share buybacks. We can see consistently reducing it from 322 to 251. Now, in terms of the ROIC, pretty strong if you ask me. 36% in 2023, 30% in 2022, and again 35% in 2021. So the last 3 years are very strong, as well as in fact the last 10 years. So this is a company with a nice high return on invested capital figure. In terms of the margins, again, pretty similar to the previous companies. Interesting how they have some similar trends. The margins are pretty much straddling around that 12% minimum we want to see. 13 in 2023. Free cash flow margin, however, consistently above the 5%, 9% over the last 2 years is a pretty strong metric. Now, in terms of the net debt to EBITDA, 2.29 in 2023, expected there or thereabouts in 2024. Again, we want to see below 3, so it is fairly comfortably below that. So we can understand why we have that very safe dividend score, and the balance sheet based on this information does look to be fairly strong. So what about the valuation of Lockheed Martin? So for today's episode, let's get in. Don't forget you can grab a copy of this valuation model if you want to get to the intrinsic value, as well as the acceptable buy price of companies in your own portfolio, or those on your watch list by clicking on that pinned comment below. 10% margin of safety at buy up to 453. At 15%, we can see it isn't too far off. So up to $428, we do see this as a 15% margin of safety company right now. So what about Wall Street? Well, they forecast around 13% upside, a little bit lower than the last few companies we analysed, but they still do believe it is a buy with a price target of $482 over the next 12 months. As always, let us know your thoughts on these companies as we run through them. Now, before we jump into the next stock, just to let you know, we have released our latest free weekly article. If you want to grab access to this, as well as tons of other articles we have done, all completely free, just click on that pinned comment below to sign up and gain access straight away. So now let's analyze a company we haven't analyzed before on this channel. It is Nestle. Now they are down 7% over the last year. Over the last 10 years, however, up 38%. And we can see their all-time highs at around that $140 mark at the back end of 2021. They're also right there at their 52-week low, and they do have a yield over 3% and a forward PE of just over 18. Nice to note the very safe dividend score of 99, market cap 275 billion. They are a mega cap company. Well, last recession they also increased the dividend, and they pretty much had average growth during that period as well. Dividend growth a little bit poor. In fact, we had an increase last month of 1.7%, below the inflation rate that I always advocate. However, over the last 5 years and the last 20 years, it hasn't been too bad. We can see they are also 2 years away from becoming a dividend aristocrat with 23 years of consecutive increases. Now, in terms of dividend yield theory, we have the double sign of undervaluation, 3.25, significantly above the 2.5 yield we see on the 5-year rolling average, and the forward P 18 versus 23, again that double sign looking very strong. We do also note it is below the consumer staples sector P of 20.2. Now, what about the free cash flow payout? Other than 2022, which was fairly recent, where they did pay out more in dividends than generated in free cash flow, it did come down to 82% in 2023. Now, industry specific for consumer staples, we want to see 70% or low. What is nice, though, is to note that in 2024, they are expecting to reduce this to around 65%. So I would expect next year, when we have the dividend increase, we should be looking at a much better, at least in line with inflation, increase. Free cash flow per share, well, 322 in 2014, 368 in 2023. Pretty flat over the longer term, although we do see an expected increase to 463 in 2024. Sales growth, again, pretty inconsistent as well. We do see that large COVID drop of negative 9%. It did bounce back up to around 8% in 2022, but in the more recent year, we do see that top line drop to negative 2%. So numerically, and if you do factor in inflation, it hasn't in real terms really increased their top line. It's gone from around 92 billion to around 93. What they have done, though, quite nicely is those consistent share buybacks, reducing those share counts by around 450 million over the last 10 years. In terms of the ROIC, this is what I always love to see, consistency on some very strong metrics, and they're consistently around the mid-teens in terms of that ROIC figure. 17% in 2023 is a very positive metric, and is also nice to note the consistencies on their margins. You could argue a little bit of operational efficiencies. They have increased it from the 15 to 16% to 17% consistently over the last 6 to 7 years, and on the free cash flow margin, looking positive around that 10% in the more recent period. So what about the net debt to EBITDA? Now, this does look like it has increased over the longer term. For consumer staples, we want to see below 4, 2.65, and around that in 2024, though, doesn't give really any cause for concern, hence why we see the very safe dividend score, and the balance sheet does look to be fine based on this information. So what about the valuation? Let's jump straight in, and for today's episode, we get a value of $119. So with the current price around $105, we get that 10% margin of safety, and we see a buy up to $107. 15%, it isn't quite there yet. So we still see, even though it is right there at that 52-week low, around 10 to 15% on the margin of safety. Wall Street, on the other hand, sees some strong upside. They have a price target above our intrinsic value, $123, with upside of 17%. So they do see this as a strong buy now. Let me know your thoughts on this company, given it isn't one we have reviewed on the channel since we started. We then move on to the next stock, which is Keurig Dr. Pepper. Now, this is one that is down 14% over the last year. Over the last 10 years, however, on a very nice run, up 248%. We can see it has hit around $40, its all-time highs, a few times over the last few years. It now offers a yield just under 3% and a forward PE of around 15.35. Dividend safety, it looks to be safe, a score of 70. Market cap, $43 billion. It is a large cap company. Now, in terms of those recessionary metrics, well, no dividend was paid in the last recession. They had above average growth, absolutely incredible, plus 44%. Dividend growth, very positive, 7.5% last September. I like to see that. Over the last 5 years, double digit, increasing it very fast, 23% on average. That is a very, very strong number. But we do note they have only been increasing those dividends for the last 3 years. In terms of dividend yield theory, well, we see a strong double sign of undervaluation, both on the yield and the forward PE. So looking very strong based on this method. Consumer staples as well, the sector P is much higher at 20.2. So let's take a look at the payout ratio. Now, this is a fairly big red flag indicator, 137% in 2023. But what we do know is that for the last 10 years, it has been below that 70% level. And in 2024, they are expecting to reduce this down to 60%. So something just to bear in mind. It does look like it should be better over the next year. Free cash flow per share, now this is a bit of a worry, $2.19 in 2015, 61 cents in 2023. It doesn't look like the most convincing in terms of the growth. In fact, it has been decreasing. The only thing we can say is that in 2024, it is expected to rebound strongly to 143, which is a positive sign. Sales growth over the last 6 to 7 years of the 10-year period looking fairly positive. 2015 to 2017, not the greatest, but we can see even in the more recent year of 5%, that is still within the 3 to 7% level that we look for a stable company like KDP. Total sales now gone from 4.5 billion. In fact, it's gone more than 3 times growth over the last 10 years to just under 15 billion. One thing we would say though is they have been issuing shares, so your position as a shareholder over the last 10 years would have been diluted, but nice to note from 2022 they were doing some share buyback. So not great overall, but nonetheless it does look like they could be moving in the right direction with those buybacks. ROIC leaves a lot to be desired for me in my personal opinion. I want to see 10% or more consistently. It is below that 6 to 7%. It isn't the greatest, but also it isn't the worst. If you are sufficient with that and you are happy, then it could be one that you could say is okay, or consider it when you are looking at your margin of safety level. Operating margin looks like they have been increasing over the longer term. 22%, very nice. In fact, every single year above 16%, this does look positive. On the free cash flow margin side, though, we can see it has been decreasing over the longer term. 6% in 2023, not looking the greatest, but again, just something to bear in mind. It has been pretty strong over the preceding years, so as long as they continue to increase this above that level, there shouldn't be a massive worry. In terms of the net debt to EBITDA, 4 is what we want as a maximum for consumer staples. 3.34 in 2023, expected to go a little lower in 2024. Nothing really to note, no real dangers here, but you could argue just something to keep an eye on as well, so it doesn't go up to the levels that we have seen in 2016 and 2018. Now, in terms of the valuation of this company, the intrinsic value for today's episode is the average of these 4 models, getting to $36. Now, what this means for the current price, around $29. As always, 10% a buy up to $33, at 15% $31, and at 20%, not that far off, just over 30 cents. So we see a 20% margin of safety. In terms of Wall Street and their forecast, again, another strong buy from Wall Street with upside of over 23%. So we can see, in fact, the majority of these stocks we have shared so far have been very strong buys according to Wall Street with upsides of 20% or more. But what's one thing very important to note here is never go off what Wall Street say. You can use it as one level of your research, but as always, when share prices increase, Wall Street will always revise their price targets upwards, and if share prices start to decrease, then they will revise it downwards. So something just to bear in mind, but we can add it in, and we do as one level of that research. The next stock that we are looking at is PepsiCo. Now down 4% over the last year. However, over the last 10 years, you would be up around 102%. And we do see it pretty much all-time highs of around $197. The yield is now over 3%, 3.07, and a forward P sitting on around 20. Dividend safety score 93. It is very safe. Market cap 226 billion. It is a mega cap company. Now, those recessionary metrics, as always, they increased the dividend during the last recession. They had above average growth, and they also outperformed the S&P negative 35 versus the S&P's negative 55. Dividend increase this month, or in fact last month, given it's now the 2nd of March, 7%, very strong, 7% over the last 5 years, 11% over the last 20 years, looking pretty strong and consistent, which is what we love to see. And they're also a dividend king. They have increased those dividends for 50 years or more. Now, on the dividend yield theory sign, we get a double valuation or undervaluation, 3.29 versus 2.83, 20.2 versus 24, and it is getting into that very, very strong undervaluation signal sign too. Consumer staples were pretty much bang on the same as the sector PE versus Pepsi. Now, in terms of the free cash flow payout, this is one thing that I don't like to see, is when it's consistently very high. And from 2018 to 2023, we have seen that quite a lot. So what I would say there is just something to keep an eye on. 2024, they are expecting to reduce this down to 77%. So it looks like it is going in the right direction. But this is one area that I would say is just to keep on your radar moving forwards quarter on quarter when looking at their guidance and looking at their annual reports. Free cash flow per share, pretty inconsistent over the longer term. It has increased $5.07 to $5.76, and in 2024 at $7.07, it is looking like it is having a nice bounce into 2024. But again, lots of things just to consider, and this will really drive that margin of safety if this is a company you are looking to invest in. Sales growth, although we have seen over the last 6 to 7 years around that 3 to 7%, with a few years looking even better. In the more recent year, 6%, it is still looking like a very strong company nonetheless. Numerically speaking, 67 billion in 2014, 92 in 2023, and they also do return that excess cash to investors through those share buybacks, 1.53 billion to 1.38. So ROIC, again, remember what we want to see is not only strong metrics, but consistency, and it's pretty much around the 19 to 20% level every single year for PepsiCo, 19 over the last 3 years. So this is a very positive sign. In terms of the operating margin, pretty consistent around that 16% that we want to see. Again, whilst I do like the consistency around that, it is something I would keep an eye on just in case we are having a recession that is coming. This could affect their margins, possibly lowering them to entice customers to buy more of their products if they have started to stray away. Free cash flow margin, we can see it has been decreasing, but again, around the 9% level for the 3 of the last 4 years is still pretty good. Net debt to EBITDA, 2.03 in 2023, 1.9 expected in 2024. So we can see why there is that essential very safe dividend score, and the balance sheet does look strong as well. So in terms of the valuation, let's get into it. And don't forget, as always, you can grab a copy of this valuation model if you want to get to the intrinsic value as well as the acceptable buy price of companies in your own portfolio, those on your watch list, or even if you want to run through these again based on your own analysis and estimates. So a 10% margin of safety, a buy up to $172 at 15%. It isn't too far off, so you could argue it is around that 15% margin of safety level. And when we take a look at Wall Street, well, they do believe this to be a fairly decent buy. Upside of 15%, a price target of just under $190. As always, let me know your thoughts in the comments below with these 6 undervalued dividend stocks. Are there any that you have been adding? Maybe some of these you've already added over the last few months, or they're on your watch list with certain price targets. If you've enjoyed today's episode, smash that like button, hit that subscribe and bell button, and as always, we'll see you on the next one.